Bank of Chile. I'm Federico. I will be hosting the session today. We have the pleasure to have Paula Beltrán from UCLA. Thanks very much, Paula, for being with us today. Before we start, let me remind you the general format of our webinars. We try to make the webinars as close as possible to a regular seminar. So during the first 5 minutes of the talk, we'll make every participant a panelist, so everyone will be able to manage their cameras and microphone. So feel free to make questions throughout the talk, but be mindful of the time so that others can ask questions and the speaker has time to answer them. So from time to time, Paula, if you can do some small pit stops to see whether there are some questions, that would be great. And we'll also leave time at the end, maybe 15 to 20 minutes, depending on how many questions we have, to have more discussion of the paper and also more open-ended discussion. So Paula, you will have around 70 minutes or so to present the paper, and I will let you know once you have sort of 30 minutes to go and 5 minutes to go. So without further delay, Paula, take it away.
Thank you. Hello, everybody. Thank you for having me. Thank you for the invitation. I'm Paula Beltrán from UCLA. I'm a job market candidate. And today I'm going to present my paper, A Lending Network Under Stress, a structural analysis of the money market funds industry. In this paper, I assess the equilibrium allocation of funding provision in a lending network under stress. This is important because funding dry-ups are very common in financial crisis. This we saw during COVID-19 and also during the global financial crisis. And second, because many financial instruments are traded over the counter and rely on a network of counterparties that is composed of bilateral relationships that are very sticky over time and typically very concentrated. During the recent funding dry-ups, these dry-ups show the importance of the links between non-bank intermediaries and the banking system. One particular market that was under significant distress was the unsecured funding market, which was very impaired in March 2020. The price dislocations were significant and large, even considering very short-term instruments. One potential cause of this dislocation is the money market funds industry, which was under significant distress at the onset of the COVID-19 pandemic, following redemptions from investors after the dash for cash during COVID-19. This industry provides a significant source of lending, especially for global banks, and it is sizable in terms of their size. They're about $9 trillion. So this is an important source of funding for financial and non-financial institutions. Yet, this industry is very special in the sense that from the regulatory and the business model aspects of the industry, they assess very seriously counterparty risk and also other aggregate risks, which in terms of the bilateral relationships translates in very long-term relationships and a very diversified portfolio. This imposes a trade-off between financial stability, because we would like for non-bank intermediaries to hold low exposures with respect to their counterparties. However, these constraints imposed by regulation and that imply concentration risk also increase the cost of funding. And this is particularly important in a crisis where we would like for non-bank intermediaries to provide lending to other institutions in the system. So just to provide some motivation, this graph shows the bilateral interest rate of unsecured instruments across banks and funds with respect to the risk-free rate. What I show is evolution in time of the distribution of these bilateral interest rates. And the y-axis shows basis points. So what we see is that during COVID-19, we observed two key trends. One is that the price of funding increases significantly. And we see that, in fact, the median rate increases for about 70 basis points, which is very large considering that these are short-term liabilities, and typically the maturity is lower than 3 months. And second, we see that during COVID-19, March 2020, we see a significant increase in price dispersion. So we see that the difference between the 25th and the 75 percentiles increases substantially, as well as the differential between the 95th and 5th percentiles of these bilateral interest rates across unsecured instruments. There have been other episodes of price dispersion, yet March 2020 was the more prominent one for this time period. So in this paper,
Sorry, Paula, just a clarification question. Do you have data for that, for the Great Recession, 2008 and 9? How would that look there?
Yes, that's a very good question. There is no data before 2011. This is data coming from the regulatory filings of the money market funds portfolio. This data is collected from 2011. Therefore, there is no data on the global financial crisis of 2008. There is data, though, on redemptions from money market funds for that period, in which the redemptions from money market funds were similar to those in March 2020. In terms of other measures of price dispersion across assets, during the global financial crisis in 2008, there was also an increase in the spread of unsecured instruments with respect to the risk-free rate, but I cannot assess the distributional aspects of these unsecured instruments during the global financial crisis because data is collected only from 2011. Mm-hmm.
Okay, but the point that you want to make is more general. It's not COVID specific, so something similar. I mean, your mechanisms should be at play also in previous financial crisis.
Yes, exactly. And the reason why I use COVID-19 though is because these shocks were kind of unexpected. The money market funds industry has experienced other periods of price dispersion, even though smaller. Two periods in this graph I would like to highlight. One is related to the money market funds reform, which happened in 2016. However, it was expected, and it was even internalized from 2015. And another episode of increasing price dispersion is related to the European crisis in 2011. However, this episode relates to riskiness perception of counterparties, and to that extent is not only related to flights from investors from the money market funds. March 2020, it's a good episode for those reasons. First, it was unexpected somehow. It comes primarily from preferences of investors that shift their portfolio towards more safety assets. And also we see a very large drop in supply for money market funds that invest primarily in unsecured instruments. Okay.
Thanks.
So with that in mind, I will assess quantitatively what is the role of network frictions in explaining the allocation of funding and the dispersion and the cost of funding after a supply funding shock in a lending network. And to do so, what I do is I build a quantitative model of unsecured lending between money market funds and banks that displays network frictions. These network frictions prevent equalizing the cost of funding across agents, and therefore have an important role in explaining the patterns of the allocation of funding and price dispersion across agents. The three main frictions I do have in my model relate to limited connectivity that allows banks and funds to trade only within a set of counterparties, which reflects the fact that in this market, we observe very long-term relationships. Second, there is concentration risk, and concentration risk is faced by money market funds, and this reflects the regulatory aspects of the industry. And third, there is bargaining frictions that will imply inefficient allocation of funds that depends on the bargaining power of funds vis-a-vis its counterparties and connectivity. Then I take the model to the data. To discipline the model, I use a data set of the money market funds. This data set includes portfolio data of the funds from which I can observe bilateral interest rates and bilateral funding from funds to banks. And with this variation in bilateral quantities and bilateral prices, my identification strategy exploits granular shocks of connected agents. And the intuition is, as in the IO literature, I use shocks in the marginal cost of competitors to estimate the elasticity of bilateral interest rates and bilateral quantities. Then I use those estimated parameters to the data. I use those estimated parameters of the data and produce a counterfactual. I take as primitives the shocks in assets under management as observed between February 2020 and March 2020. And I quantify what is the role of these frictions in March 2020. Then I see what is the allocation inefficiency after a large drop in the supply of funding. And I assess as well what is the role of the overnight repurchase program as a policy tool. So let me summarize my results. The first result is that that the model can account for a sizable share of what we observed in March 2020. So taking as primitives the drop in assets under management for funds, those shocks can account for roughly 70 and 85% of observed outcomes. And there are three key aspects that the model predicts well. First, the cost of funding increases and increases about 66 basis points, which is comparable to what we see during March 2020. Second, there is a substantial increase in price dispersion across unsecured instruments that increases after the drop in assets under management. And this is similar to what we observed at the onset of the COVID-19 pandemic. And also, unsecured lending drops, and it drops more than the fall in funds assets. This implies that funds do not have incentives to increase their portfolio share in unsecured funding assets, and instead they will go to their outside option assets and increasing their portfolio share towards those other options. Then I assess what would be the planner's allocation and the same constraints and preferences of the banks and funds in my model. And therefore, this is a quantification of the bargaining frictions. And what I see is that the planner's allocation reduces funding by less than the folding assets, providing some evidence that the decentralized solution provides lower funding than optimal. And these effects are mainly affecting those banks that are poorly connected. And we observe distributional effects across banks. And also, I test what is the effect of the overnight repurchase facility, which is an outside option for funds in the model and in the data. And since March 2020, the fund's portfolio share in the overnight repurchase facility has increased massively. So I assess what is the importance of this facility as an outside option for funds. And what I see is that reducing the overnight report rate reduces the median rate, but implies a further fall in funding. This implies that this facility is an important outside option for funds and increases the bargaining power of funds when negotiating with the counterparties. Okay, so let me introduce, speak a bit about the related literature. There is many papers related to my paper. My marginal contribution with respect to the literature is to quantitatively assess what is the effect of a large drop in the supply of funding in a lending network in a model that allows for bilateral bargaining power and rich heterogeneity across agents. Second, I can assess what is the allocation efficiency in a lending network under stress. And also, I'm the first that provides an identification framework for the joint estimation of bargaining power and network effects. So let me introduce the model. The model is composed of banks and funds. Banks need funding and funds provide funding to banks. Both banks and funds have mean variance preferences with respect to aggregate risk, and funds have concentration risk. Banks and funds trade bilaterally given a network, which I take as exogenous. This assumption reflects the fact that in the data, there is long-term relationships, and as measured by the median length of the relationship, which is about 48 months. And also, it is very unlikely to form new links during a crisis. In fact, during March 2020, the share, both in number and in dollar value of the new trading partners, was significantly small. And also, this exogeneity of the network, not only is a plausible assumption, but I allow for the extensive margin of using your counterparties, meaning that links can be shut down in the bilateral negotiation. So let me introduce first the funds problem. Funds are given some assets under management, which are SF. And this is an important object because SF, I take SF as given, and I'm going to introduce the change in assets under management from February to March 2020. So the shocks that I'm going to introduce in the model are coming through the model through SF. Funds face a portfolio problem in which they can invest in three types of assets: unsecured lending, treasuries, and the overnight repurchase facility. Unsecured lending is the sum across all the funds counterparties, where QBF is bilateral funding from a fund F to a bank B. And the other two options are treasuries, which implicitly I'm assuming that treasuries capture all the securitized assets. And the M here, MF, is the holdings in the overnight repurchase facility at the Fed, which gives an fixed interest rate for funds and is the risk-free asset from the perspective of funds. So these are the preferences of the fund. In the top line, I do have the return on assets. So the first two terms in the top line are the return on securitized assets and the return on the reverse repurchase facility. And the third term is the return on unsecured funding across the fund's counterparties. So notice that here RBF is the bilateral interest rate charged by the fund to a particular counterparty. And epsilon BF is an additional trading motive, which I'm going to use for the calibration of the model. And in the bottom line of the preferences of the fund, there are two terms. One is related to risk aversion, aggregate risk aversion, and the second is related to concentration risk. Risk aversion or aggregate risk aversion is governed by the parameter alpha F. And notice that here I assume that both securitized assets and unsecured funding imply some risk-bearing capacity from the fund's perspective. The second term, which is related to concentration risk, is governed by phi F and relates to the fact that funds have a very hard time in increasing their bilateral exposures to a particular counterparty. This assumption captures the fact that the regulation on money market funds is very strict on concentration risk, and funds cannot invest more than 5% of their portfolio in one particular counterparty. Therefore, when these constraints are important, this parameter phi F should be larger, and this increases the cost of funding. So there are two main reasons why the marginal cost of funding is increasing. One is related to aggregate risk aversion, and the other is related to concentration risk. Both imply increases in the cost of funding. However, they do have different effects in the model. In particular, concentration risk or the cost of concentration risk from the perspective of the fund depends on how many counterparties does the fund have. Whenever the counterparty has a large number of counterparties, it can split this concentration risk across all its counterparties. Meanwhile, when funds are connected to a very low number of counterparties, concentration risk becomes more important in determining the cost of funding to a particular counterparty.
Paula?
Yes.
Yeah, a question. The fact that in the second term, you're summing Q and T means that you're assuming that the risk associated to unsecured lending and treasury is the same?
Yes, in this version of the model, I'm assuming that the aggregate risk and that the fund is holding or bearing is the same for securitized assets and for unsecured funding. I do have another version of the model in which there is differential aggregate risk bearing coming from these two types of assets. In that version of the model, depending on how larger is unsecured, the effects of the difference between unsecured funding and treasuries in terms of risk, the effects are going to be larger in terms of the drop in unsecured funding. And the rationale behind that would be that given that you're going to have to hold more risk when you hold unsecured funding, you have incentives to even increase more your holdings of securitized assets. Mm-hmm.
And the second question is the epsilon in the
Mm-hmm.
third term of the first term, this trading motives.
Mm-hmm.
This is associated to utility or to money? I mean that it's something that goes to balance sheet, or something that you know, I don't know, for some reason do you have more utility, but it's not the money.
This is a good question. And the way I think about these trading motives, and the reason why I introduced trading motives, is that there exists, from the perspective of the data, there is a rich variation across banks and funds, even for the same type of unsecured instrument, meaning that even conditioning after maturity and other characteristics of the assets, the pricing is substantially different across agents. So therefore, for the model to being able to reconcile these observations, I need those additional trading motives that capture that the fund perceives more a larger interest rate that may be not monetary in the model. Mm-hmm.
Paula, one question. Sure. On the concentration risk part. So
sure.
Two questions on that.
Mm-hmm.
So first is that I'm not sure I understood it very well, because here you're saying something like, imagine you have Q is the same for a given fund, Q is the same across B. If you increase one B, that's going to increase the cost, but that would lower the concentration. So that seems kind of
yes.
counterintuitive to me.
I don't have it here in the slides, but the marginal cost of funding to a particular fund is an expression that depends on QF through two channels. One through aggregate risk aversion, and second through concentration risk. And then concentration risk is lower whenever you have more counterparties, conditional on the same quantity that you want to hold in unsecured funding. So let's suppose that you take as given your position in unsecured funding, conditional on the same unsecured funding provision, regardless of your which counterparty you're allocating those funds. The marginal cost of funding, conditional on that QF, that increases, that decreases with the number of counterparties you have. And the idea is, suppose you have a pool of money that you want to hold in unsecured funding. Whenever you have many counterparties, it's easier to split that same money than when you have a very few number of counterparties. Does that make sense?
I see. Okay. So you're saying something like Q would be adjusted by the number of counterparties you have, and that would make the concentration risk to be lower if you have more counterparties.
Exactly.
Okay. And then the second thing, I mean, I'm not sure like the theories on these, but on this object,
mm-hmm.
But like if there's a concentration risk, you know, that's part of the market structure,
mm-hmm.
then you would think that those things would be priced. So then you wouldn't need to have this sort of additional term, because those things would be sort of priced appropriately in the returns that these assets have, and you're being sufficiently flexible to make these returns to be BF specific. So there's some flexibility there in the market to kind of accommodate these risks. but somehow you're saying that, you know, the market is not able to do that, and that's why you have to add this additional term. Is that the way you're thinking about, or not?
To rephrase your question, so you're saying that there are two things that they that internalize in the model the differential across agents. One is coming from the trading motives, and the second is related to concentration risk. Right?
Yeah.
That's what you're saying. So why do you have concentration risk? Okay. That's a good question. When thinking about the data, the cross-sectional variation in prices does depend on the bilateral quantities. Yeah, there is still some variation that is unexplained and that is substantial. So to that extent, those gains from trade from the perspective of a fund at the bank could be captured by those trading motives. Yeah, notice that there is also a correlation between QBF with respect to bilateral interest rates, and that captures the fact that from the perspective of the funds, it becomes more costly to increase your bilateral position. Also notice that trading motives and concentration risk in the model are imply two different things. And concentration risk is a quadratic term. Meanwhile, trading motives is linear, meaning that that term on concentration risk is a variation coming from risk bearing, if you will, at the bilateral level. Meanwhile, epsilon BF just captures additional gains from trade that are not captured by that quadratic term in the model.
Yeah, no, definitely. I mean, I can see that it's going to add something on top of what you have. I mean, on top of the other things that you have. But my question is sort of like, how could you microfound this in a way that, I mean, I guess you're kind of imposing in some sense that, you know, the pricing that is absorbed in or represented by RBF is kind of not sufficient to accommodate the decisions that funds and banks are making. So, I mean, I can see that that's sort of a friction in itself. My question is sort of how can you kind of microfound that? Because at this level, it seems like, you know, this is something you're imposing. This is an assumption, and it's going to give you, you know, departures from. It's going to give you dispersion for sure, right?
Yes.
But then the question is a bit, you know, how can you sort of justify that this is sort of the way that the market works, and you see what I mean?
Paula?
Yes, that's a good point. I think this epsilon BF, and there's going to be a similar term in the bank's preferences. Those are used for calibration, and in the model, those would affect the gains from trade for a particular link, meaning for a particular fund and bank. Those would relate to some additional trading motives that I'm not modeling so far and relate to the gains from trade. To assess your question, what I would do is have a model of endogenous network formation, and therefore those epsilon BF or trading motives would be capturing those gains from trade that I'm not assessing so far, given that I'm taking as given the network as exogenous.
Paula?
Model with endogenous formation. Let me finish and I'll go back to you. So a model with endogenous network formation would imply those wedges with respect to pricing or competitive pricing, if you will, that are related to additional gains from trade that you have because of the long-term problem, if you will. So far, I don't assess that because I'm focusing on the short term, and I take as given those gains from trade as observed before March 2020, if you will. And then the counterfactual is just mainly changing the pool of money instead of changing the gains from trade. That would be my answer to your question.
Okay.
Yes. Do you have a question?
Here. Yeah. I had the same question than Federico, and I believe it's similar to one of Alberto. It seems to me that there is a mapping between your modeling choice and the Breeden formula of the consumption CAPM, where you have the mean of the returns and you have the variance in the risk aversion and the concentration risk.
Yes.
The new thing is that you add the network effect in the concentration risk, which is nice. And also you have this epsilon that could be interpreted as a liquidity premium, something similar to what Acharya did in his paper of the liquidity CAPM. So I believe it's not that that exotic. I think it's more mainstream of what we have in finance so far. But it would be good to have it more mapped to the literature.
Oh, thank you for the comment. If you do you have the reference, can you send it to the chat? That would be great. Thank you. Okay.
Hey, Paula. Hi. Sorry, I also have a question regarding the utility function, because if I understand correctly, here what you have is on the return, you have at the end of the day a sum of money that you put in and you receive a return. So in that sense, it would be closer to something like a money in the utility function than to mean variance analysis, because in there you have the utility, it comes from the return of the portfolio, not the amount of money that you have in the portfolio. And the variance comes from the variance of that return. And here you have like variance of the amount of money. So yeah, so I'm a little puzzled about the utility function.
So wait, can you repeat again which part you find puzzling in particular?
Here you explain that you have that you base this utility function in the mean variance, the typical from finance in undergrad. Here you have more of a money in the utility function utility, looking that you're based the utility on the size of your portfolio than in the return of the portfolio. That's my concern.
I believe this maps to a portfolio problem, in the sense that suppose that you want to take out the first order condition with respect to your bilateral portfolio share, your bilateral funding provision. At the end, it is linear in size. So to that extent, it maps somehow to what you're thinking, which is a portfolio problem. In other words, the marginal cost is linear in the portfolio share.
Okay, we can talk about it later, but
sure.
Yeah.
Okay. Okay, and the preferences of the bank are similar, except for the fact that they do not hold concentration risk. By regulation, they could also have some concentration risk, but I'm not assessing that because I want to focus on the effects of concentration risk in the money market funds industry, and I do that for simplicity, but there is a version of the model in which I could allow as well for concentration risk in the bank's problem. So here in the bank's problem, QB is the total dollar borrowing, which is the sum across all the bank's counterparties, which is QBF, the bilateral funding for a particular from a particular counterparty F, And in the setting, alpha B captures the risk aversion of the bank. And notice that here SB captures the size of the bank, which I'm going to discipline with the total assets of the bank. And here in the setting, the cost of the bank, besides risk aversion, comes from the payments for a particular counterparty, RBF, and an additional trading motives, which are CBF, which I will use in the calibration to match the bilateral quantities and bilateral interest rates. So for each link, for each pair bank and fund, I do have two observations. What is the bilateral funding and what is the bilateral interest rate? To be able to match those by pair, I require at least two degrees of freedom, and to that extent, I use this CBF and also epsilon BF to be able to match those in the counterfactuals. In the setting, AB is the return on assets of a particular bank. And again, this model allows for heterogeneity in the return on assets at the bank level. So as for the bilateral trading, funds perceive the assets under management as F. And at the beginning of the period, funds choose how many securitized assets they want to hold. Then for each link, for each pair bank and fund, a pair of traders negotiate bilaterally and then decide together the bilateral interest rate RBF and the bilateral funding QBF, which is determining a Nash-Nash bargaining game. This means that they take as given the negotiations on the other agents, meaning that they take as given the negotiations of other funds and banks. And here, the relevant outside option of the funds is the reverse repurchase facility. So the equilibrium is going to be characterized by a set of a set of securitized assets for each fund. And a supreme perfect equilibrium is characterized by those that set of securitized assets that solves the problem of the fund, taking as given the solution in the bilateral negotiation, which is characterized by bilateral interest rates and bilateral prices that take as given the first stage of the game, securitized assets, and holdings on the overnight repurchase facility are solve the residual from the portfolio of the funds. So as for bilateral funding, optimal bilateral funding satisfies that the marginal benefit is equal to the marginal cost. And the reason is that this is a negotiation in which banks and funds trade bilaterally and maximize the bilateral surplus. And what is important from this equation is that notice that the equilibrium quantities or bilateral funding will depend on the funds and banks' total exposure to unsecured assets, and also to the position of the funds in treasury holdings or unsecuritized holdings. As for the bilateral interest rates will depend on bargaining power, and the price of the contract will be equal to weighted average between the bank's benefit with respect to the bank's outside option, and the fund's benefit with respect to the outside option. And the weight on those would relate to the bargaining power. So tau BF here is the bargaining power of the fund, and 1 minus tau BF is the relative bargaining power of the bank vis-a-vis this particular fund. Notice that this implies that when the fund has full market power, the price of the contract is going to be equal to the bank's benefit minus the outside option, which means that the utility of the bank in that particular case is that one of the outside option. On the other side, if tau BF is equal to 0, this means that the bank has all the bargaining power, and therefore the price of the contract compensates the fund for exactly the cost of providing funding and the outside option. So to that extent, the utility that the funds perceive is that one of the outside option when they have very low market power. Because of linearity, we can find a function of the bilateral interest rates that depend on the position of the bank and the fund with respect to unsecured funding. And here, that elasticity of bilateral interest rates is captured by theta BF B and theta BF F, which depend on the bargaining power of the fund. And in fact, this elasticity is linear in tau BF and depends on the remaining parameters of the model. So suppose that I know the cost of risk and concentration risk. Given those parameters, if I identify the elasticity of bilateral interest rates with respect to the fund and bank's position in unsecured funding, I could identify the bilateral bargaining power, because the relationship between these elasticities and the bargaining power is monotonic. Furthermore, what is key and the key takeaway from this slide is that these bilateral interest rates will be a size-weighted average of the banks and funds cost and benefits, and that therefore dispersion in bilateral prices will be related to dispersion in bargaining power, but also dispersion in the banks and funds opportunities of investment. So to summarize,
Paula, you have about 25 minutes to go.
Oh, okay. So to summarize, the model has two main equations in which bilateral lending depends negatively on total exposures, and therefore identifying the elasticity of total exposure with respect to of bilateral exposure with respect to total exposure, I can identify the ratio of total risk aversion and concentration risk. And from the elasticity of bilateral interest rates with respect to the total exposure of the bank and the fund, I could identify an expression on bilateral bargaining power. Now, the risk misallocation from the bargaining friction in the model, and then the wedge with respect to the planner is captured by mu L and mu H. Mu L is that one that is positive and is positive whenever the fund has low market power. That's what the L stands for. And this implies that the fund has incentives to reduce their unsecured funding by increasing their position in securitized assets, because whenever they have low market power, they will receive the utility of the outside option, and therefore they have incentives to increase their position in other risky assets and not on unsecured funding. And in this way, they're increasing their bargaining power in the second stage of negotiations. Second, when the fund has high market power, it has incentives to overprovide liquidity to banks, because when they have large market power, the utility of the fund is that equal to the total surplus and discounting the bank's outside option. Therefore, the fund would like to reduce the price of risk by reducing their position in securitized assets. So to take the model to the data, I use data from the money market funds industry. I use the monthly filing report of the fund's portfolio, in which I can identify the bilateral interest rates and bilateral prices. And I'm going to focus on the prime segment, which was at the core of the of redemptions during March 2020. And I focus on unsecured lending instruments, mainly commercial paper and certificate deposits. And for banks, I control for monthly CDS, equity returns, and I have information in the quarterly balance sheets for the banks as well. So to sum up, the structural model depends on two main effects. First, aggregate risk aversion, concentration risk, and market power. And the identification strategy will rely on the fact that I can observe bilateral interest rates and bilateral quantities. And for bilateral quantities, I can remove the commonality in bilateral claims to be able to remove, for instance, aggregate risk aversion shocks or institutional conditions that relate to funding needs that might be correlated to the demand and supply of a particular bank and fund. And then using those shocks purged from those aggregate conditions, I can build an optimal instrument for the banks and funds position. And the idea is that the empirical challenge is that that unsecured funding positions of the fund and the bank depend as well on the bilateral funding mechanically. And therefore, if we were to estimate the elasticity of bilateral funding with respect to total funds position, for instance, we would very likely would get a positive elasticity just coming from the mechanical correlation between total unsecured funding position and bilateral funding position. So to assess this empirical challenge, what I will use are shocks to connected neighbors that affect, in this slide would be affecting QB prime F, and move the unsecured funding provision of the funds without being correlated to the bank's needs for funding or other confounding factors. So demand and supply depend on trading motives of connected agents, and therefore I could use them for identification, and how important they are, it's going to depend on the network and the key parameters of the model. So what I do is I use the following strategy that extends Gabex and Cogen regular instrumental variables to the context of a panel setting with bilateral shocks that is able to identify heterogeneous effects across the network. So to do this, what I do is I take an initial guess for the key parameters of the model, which is the ratio of aggregate risk and concentration risk. And then with this, I use this guess to compute the gains from trade. And then I extract some aggregate shocks and leave some bilateral shocks that are plausibly exogenous. Then I compute an instrument using those bilateral shocks that affect the total position through the network. And therefore, I can use them for identification of these two parameters of the model, which are the ratio of concentration of risk aversion to concentration risk. And the relevance of the assumption, the relevance of the instrument depends on non-uniform weights on those bilateral shocks. This comes from two sources in the model. One from variation in size across funds and banks, and second from variation in the set of counterparties. Suppose there is no variation in the set of counterparties in the particular scenario, the influence of a particular shock of a particular partner will influence all in the same way. Therefore, there would no meaningful cross-sectional variation. And second, the exogeneity assumption is that bilateral shocks are orthogonal to aggregate condition, and a sufficient condition is that bilateral shocks of competitors are not correlated across the network. So just let me show you the estimated parameters. Here I'm presenting the parameters for the elasticities of bilateral interest rate with respect to total exposures. And what we see is that there are key differences between the OLS and the IB estimator. The OLS captures that mechanical correlation between total exposures and bilateral exposures. Meanwhile, the IB captures this substitution across the network of counterparties. These estimates are large, meaning that in terms of the standard deviations, one standard deviation increase in the fund's portfolio exposure reduces one standard deviation in bilateral lending. So this is substantially large. And one standard deviation in the bank's portfolio exposure reduces 0.4 standard deviations in bilateral lending for a particular bank. And also, notice that here, estimating this ratio, I would like to estimate them separately. In what follows, I will show you that I can estimate some bounds for concentration risk, and using a particular parameter for phi-f, I could predict what will be aggregate risk aversion for banks and funds. So here, this proposition
Paula?
is about, yes.
Just a quick question regarding to the data and the estimation. What is the frequency? What is the frequency of the observations?
Yes, this is monthly. For banks' assets, I observe them quarterly though, but the portfolio is monthly.
Yeah, I was wondering because mainly the big shocks are observing in a daily frequency. So how you solve this issue?
Yes, I cannot assess that because my data is monthly, coming from the filing on regulatory filings. There is other data though, which is weekly and only includes information about the assets under management of the funds. So I could not be able to estimate those parameters using daily data for that reason. But what is important here is that this framework allows for the identification of these effects in other markets in which you can potentially have daily data or more granular data at the time in terms of time frequency. Okay. So then I can estimate a combination of parameters of bargaining power and concentration risk, but I can also identify bounds for concentration risk. So given those bounds, I take a conservative approach for concentration risk and identify the bargaining power of the fund vis-a-vis the bank. So here, the estimated bounds are between 4.5 and 9, which is in line with the parameters of the literature. And this graph shows the distribution of market power of the fund with respect to the bank. So what we see is that it is considerably low and below 0.5 for the majority of the funds. And this will reflect in misallocation of funds and a reduction of unsecured funding. This market power, in terms of how it depends on size and number of counterparties, here I show the market power of the fund and the correlation of this bargaining power with respect to some measures of size and number. So what we see is that it is correlated to the size of the bank, meaning that a large bank has more market power, and also it is positively correlated with the number of counterparties the fund has, meaning that a fund that has more market power, a fund that has more counterparties typically has more market power. So then I run some counterfactuals. So notice that the observation level is bank and fund, and I calibrate the model to match the initial distribution of quantities and prices. So I match the distribution of bilateral lending and terms of trade as of February 2020. And I use estimated parameters of the model and take as given the initial assets under management to calibrate the model. Then what I do is, let me show you again the distribution of bilateral interest rates of the data for between banks and funds. I will see how much of this dispersion can be explained from the model. And to do so, I introduce shocks in assets under management as observed between February and March 2020, which total about 11% of the assets under management using monthly data. And then notice that this is substantially heterogeneous across funds as well. So here is the result in terms of dispersion in prices. So what we see is that the model predicts a substantial increase in the cost of funding with respect to the initial bilateral interest rates. So what we see here is that it is about an increase in about 50 basis points in the bilateral interest, in the median bilateral interest rate. And also we see that there is a large increase in the interquartile range, and also in the differential between the 95th and 5th percentiles as well. This difference is about 100 basis points, which is similar to the 120 that I observed in the data in terms of price dispersion. And this is even more important across banks. So here I'm plotting the distribution of size-weighted interest rates perceived by banks. So we see that banks, there is some distributional effect across banks, and there is substantial dispersion in the opportunities of investment across banks as well. Also, these distributional effects for banks depend on the number of counterparties, and banks that are connected to more counterparties are able to get more funding than those that are not, that have a limited number of counterparties. This shows that that connectivity in the network is important for allocation of funds under stress. As for allocation efficiency, the model predicts a drop in 14% in unsecured funding in the decentralized solution, which also implies a reduction in the portfolio share of the funds in unsecured funding. Remember that the drop in assets under management of the total market is about 11%, and the observed drop in unsecured funding in the data is about 16%. So this is significantly close to what we see in the data. And the planners, what I ask is what a planner would do in the face of the same shock, under the same network and same preferences. And then this is a quantification of the bargaining friction in the model. What I see is that the planners drop in unsecured funding is 9%, which is lower than the drop in assets under management, and shows important differences between the decentralized solution and the planner solution. So in this graph, I show the percentage in assets under management, the change in assets under management in the horizontal axis, and in the vertical axis, I show the change in bilateral funding. So what we see is that there are substantial differences between the decentralized solution and the planners at the granular level as well. And then I ask, what is the importance of the overnight repurchase facility? This is an outside option for the funds when negotiated with banks, and therefore might increase their bargaining power vis-a-vis its counterparties. And then I produce a large drop in the overnight repurchase facility rate to see what would be the effects in terms of unsecured funding. And what I find is that this drop in this rate would imply an even larger drop in unsecured funding. And the reason is that it reduces the incentives for funds to provide funding for that reason, because they do have very low market power vis-a-vis its counterparties. The bottom line of this exercise is that this facility is important for provision of funding of funds towards banks. So let me conclude with the following. In this paper, I provide a quantitative framework to measure what are the effects of a large aggregate drop in the supply of funding in a lending network that allows for bilateral market power and ratio heterogeneity across agents. In the model, network frictions can explain what we observed during COVID-19, at the onset of the COVID-19 pandemic, for the money market funds industry and unsecured funding towards banks. I also show that the allocation is inefficient and funds provide less funding that would be optimal. And I also show that this overnight repurchase facility is also an important policy tool to incentivize funds to provide funding. And as for future work, the model doesn't take a stance about network formation. A potential extension of the model is analyzing the expensive margin and the dynamic problem of network choice and the endogenous gains from trade that are exogenous in the model. Also, future work would benefit the literature focusing in what is the implications of monetary policy pass-through of frictional intermediation of non-bank intermediaries. In the model, I showed that the overnight repurchase facility is an important policy tool, yet assess the effect requires taking into account also other types of non-bank intermediaries that I don't have in the model yet in the context of a general equilibrium model. And for emerging economies, non-bank intermediaries also provide a large share of funding, especially when they have large holdings of banks' assets. And those non-bank intermediaries are also prone to shifts in preferences from investors coming from local and global events. Therefore, starting the transmission of these other shocks in investors' preferences through non-bank intermediaries in the context of frictional intermediation is also an important step to take when analyzing the transmission of the shocks through non-bank intermediaries. And with that, I conclude. I think I did well on time, right?
Yeah, great. Thanks, Paula. We have some time for discussion, and so feel free to ask questions.
Thank you.
Paula, hi, Andres Fernandez here.
Hi, Andres.
I have a couple of questions or comments. So one is on the policy implication. You did mention at the beginning that the central planner does reduce the funding to less connected banks, right? It
was the other way around, that in the case of the decentralized solution, they would drop even further the allocation of unsecured funding than the planners, in particular for banks that are less connected. Yes.
Okay.
Yeah.
It did not sound too intuitive, so that's why I wanted to double check. And then the other thing is more like a remark on your extensions at the end, the future work. So one thing that we've done here in the bank, focusing on COVID, is to see what has happened to several of the markets, mostly markets where firms are involved, not necessarily financial markets, but there's been a lot of reshuffling in terms of the connections of networks, right? So we've seen a lot of connections being destroyed and brand new others being formed. You can test this with the data, right? You can see whether new connections have arisen. So that would speak to the necessity or not to endogenize this network.
Right.
Just a thought.
Yes. Well, here in the model, I'm focusing on the short-term effects. So to that extent, I focus on the change between February and March. and which are very short-term effects. To that extent, I don't speak about the formation of new links. During March 2020, what I see in terms of new trading partners, in terms of above dollar value and in terms of number of new trading partners, is that it is very low, the share. And the reason is that from regulatory aspects of this money market funds, they take serious consideration of which banks are they comfortable trading with. And this risk consideration of the counterparty is done once a year, if so. So to that extent, it is very hard to create new links in the network, at least in the short term. And of course, in the model, I assume that the network is exogenous and games from trade that are exogenous as well. Then an important extension of the model will see the dynamic problem. And that's important because there is a trade-off between financial stability and at the same time, the cost of funding during a crisis. What I show is that this counterparty risk is important, more so for those funds that are connected to very few links in a crisis. However, from the perspective of policy, would like to assess as well the dynamic problem of the network formation and why those links are there might be related to concentration risk as well.
Got it. Thank you.
Paula, I had a question about the friction. So you make a couple of decisions in terms of which friction are important. So one question is sort of, what would you lose if you take out? I mean, I guess the bargaining friction makes sense to me. My doubt is on the concentration risk, and sort of what would change in terms of the prediction and how they map to the data if you didn't have that. So what would you lose without that? And kind of related, I mean, I'm not on top of the details of this market, but wouldn't informational frictions like information asymmetries also be important in terms of, I mean, that would affect the bargaining, but would also affect maybe the endogenous part of the extensive margin that you were talking about in terms of sort of which relationships are built and so on. But even like given the relationships, information asymmetries could change also pricing decisions between these funds and the bank. So I wonder whether that's something important to think about in this context.
Okay, so as for the first question, concentration risk is there, capturing the regulatory aspects of the money market funds. It is also there to have a model that is simple enough to solve. Small concentration risk would imply closed form solution as well in the model. And that's a modeling choice I make based on other papers in the literature as well. That makes the model tractable enough. As for what would happen when we drop concentration risk, what would happen is that the model would equalize the marginal cost of funding across all connected agents. So notice that here the network is exogenous, and I assume that there are some banks that are not and funds that are not able to meet. For those, it's like that parameter is infinite, right? Taking that concentration risk to zero just means that you'll have an equalization of the marginal cost of funding across partners that are connected in the model.
Wouldn't the bargaining give you dispersion on that? Wouldn't that be enough? Maybe I'm missing something.
Right, there is dispersion coming from bargaining frictions as well. That is right. And the model without bargaining frictions also has dispersion as well. That is true. In the model, I believe that the dispersion is mainly coming from dispersion in the opportunity investments of banks and how connected they are. But having those edges of market power in this industry make sense because this is also a very concentrated market where key fund families capture a significant share of the market. And as for your second question, I also believe information frictions are important. I don't assess the role of information frictions so far. That will be a possible extension of the model. Yet, in terms of the tractability of the model, I will lose some of that as well. I'll have to make an assumption that simplifies the information problem, but I believe that that would affect the tractability of the model. Mm-hmm.
Paula? Mm-hmm. Very, very interesting and very interesting paper. But I have the following question. Many people think that the problem in this market is related to regulation, that basically prevent market makers or traditional market makers to, you know, to enter into the market to equilibrate the market. So my question is, I think that concentration risk, you know, you could map concentration risk to these regulatory issues, but I don't know if it's possible to do with your model a more direct connection between both things, because or maybe in the data, maybe you could exploit data, you know, before and after change in regulation. I don't know if the time from 2011 to 2020 is enough for that, but question is, it is possible to make a more direct connection between regulation and your results?
Yes, that's a very good point. There is one significant reform that happened in 2016 that changed significantly the structure of the market, coming from regulatory aspects of the reform that implied that it was harder for funds to raise their profits through two channels, concentration risk and also risk taking. However, this reform was announced in 2014, and to some extent, it was taken into account even before it was in place. So we see some dispersion in the market even in 2015 before the reform was in place. So as to how to assess changes in regulatory aspects, it is very hard to do because those reforms are typically announced with significant time. There is going to be another reform soon, and the SEC announced that a couple of days ago, in which, in essence, from the lens of the model, it would imply a larger risk-bearing of the funds, as well as what happened as well during 2016. However, to the extent that those are announced, it is difficult to assess what is the role of those in the data. What I could do, though, is assess what would imply a change conditional on the network on those parameters. With that in mind, a larger concentration risk implies larger drops in unsecured funding and also larger dispersion in the cost of funding in the through the lens of the model, and with exercise I've done in the past. Yet the model would not allow thinking about network formation and funds going out of the market, which is what happened as well in during the reform of 2016, and I predict would happen and continue happening after the new reform. Mm-hmm.
Thank you.
Mm-hmm. Sure.
Paula, one question.
Mm-hmm.
I wonder if, given what's been said before about regulation, I don't know if you have data on each fund's policies regarding redemptions, because one of the main drivers here is that in COVID you had large redemptions, and some funds were more prepared than others to smooth those redemptions. So I was wondering there's one heterogeneity that you can exploit regarding the differences in the funds prospectus in this regard?
Right. Well, there are other papers that show that there is some correlation between redemptions and the weekly liquid assets. There's also some differences across investor type, as you mentioned, in terms of redemption. In the model, what I do in the counterfactual is I take those as given, the changes in assets under management, and regardless of what is the type. I would say that if anything, there may be some increases in risk aversion that are differential across types. In the model, I don't assess what is the effect of risk aversion. I take it as given, and to that extent, my counterfactuals would be a lower bound of the effects that I would perceive in the case of increasing risk aversion. So to that extent, I would say those are a lower bound. Mm-hmm.
Thank you.
Sure.
Any more questions? We have a couple more minutes. I had a doubt on the identification strategy. So you had this assumption of sort of no correlation of this V across bilateral bank funds. But I wonder, I mean, there must be some like spatial correlation that is important for, I mean, especially like a market like the US, you know, like you have these small banks in some regions where you might think that, you know, it's going to be very important for the bargaining power that funds have on these banks, or vice versa. And so you might think that there's some spatial correlation, like bilateral across banks and funds, that you know, could be a threat, or I mean, for identification, or is there some, is that something you're controlling for?
I believe that as for US banks, there are very few that are important in the market. These are typically global banks. So the main spatial correlation would be the country level. In the estimation of the bilateral shocks, I take out as well country level time effects, which means that I capture somehow for potential confounding factors that relate that for special funding needs for a particular country, or a special riskiness of a particular country as well. So to that extent, there is some of that taken into account through those effects. Yes, if there is another type of correlation across banks, spatial or financial, through other financial institutions, for instance, I could control for that as well. But doing so requires an estimation of that correlation, which is challenging as well. But that could be done as well, and it's a robustness check that I need to do.
Okay.
Sure.
Any more questions or comments? Okay, I think we're right on time. Paula, thanks a lot for being with us today for this great talk and discussion. Thanks everyone for joining the session and participating. It was great having you, Paula, and stay tuned for next week's webinar.
Sure. Thank you so much, everyone, for having me and for all the comments and questions. This has been great. Thanks a lot.
Thank you.
Bye, everyone.
Bye.